Hey everybody, this is Rob Keynes with the Freedom Report, and we have a very special guest returning to us. He was here a few months ago talking about potential stock market correction and other things in the economy. We wanted to bring him back and give you a preview of what may be happening the rest of the year. This is Stephen Hochberg. He is part of elliottwave.com. He's been an analyst that's been on Barron's, Bloomberg, CNBC, MSNBC, Los Angeles Times, as well as many other. He began his career at Merrill Lynch. Enjoyed Elliott Wave International in 1994. So he's been doing this for a long time. And Stephen, welcome back to the program.
Thanks for having me, Rob. Really appreciate it.
Yeah, absolutely. So it was really prophetic when you came on before, because you were talking about potential stock market correction coming during the summer. I don't know if it went full correction, but it did pull back definitely. And I think we saw some weakness in the stock market. And fast forward to today, we're looking at labor conditions. Labor conditions are not very strong. We've had, I think August, it came out from the Challenger report, had the most layoffs in any August of the past 15 years. That just came out on CNBC this morning. So definitely we're seeing trouble in the economy. And so I wanted to get your view, kind of maybe start us off with like an overall, 4 to 5 minutes or whatever on what you're seeing in the market. What are the concerns? And, if it's acted like you thought it would back when we originally had the interview back in February, or if you feel like things have changed a little bit in the market.
Yeah, you know what else happened in August that was really interesting, I read about the other day, was that this August had the third highest number of bankruptcies over the last 24 years, since 2000.
Wow, I didn't know that.
So there's things going on in the economy underneath the headline numbers that if you peel back the onion skin, you can see a little bit that things are weakening out there, and just and the numbers that you cite, and that we're going to see with the job numbers and so forth. But in terms of the market, I mean, we're really excited about the situation we're in right now. Market had a rally, carried a little bit higher than we initially anticipated, but you had a pullback in April. Then you had a real big dive from July to August, where the NASDAQ lost about, I think, 16% of its value. And then we came into August 5th, and all of a sudden, everyone just rushed right back into the market. But what was really interesting to us is that there's only one index that went to a new all-time high of the three major ones, and that was the Dow. The S&P 500 didn't confirm the new high, and the NASDAQ 100 has been lagging notably. And what else we're noticing is that if you look at an index of, say, artificial intelligence stocks, which have been kind of the focus or focal point of the mania, they peaked months and months ago. So they're lagging desperately, or they're lagging considerably as we go forward. So these are all signs from our perspective that the upward momentum of the market has been waning for a period of months. And we're entering a seasonal period that historically has been very, very difficult for stocks. And so when you line that up with the Elliott wave pattern, which we see is completing from the October 2022 low, and on top of that, you have sentiment, which is just off the charts bullish. I think the combination of the three sets us up for a very exciting several months to the end of the year, where we can see the market really get hit pretty hard on the downside.
Yeah, I want to dive just a little bit into AI, because that's definitely been the story of the last couple of years. In ChatGPT, Grok on Twitter, AI, solving a lot of problems. There's been talk about AI replacing jobs in software development, things like that. Why do you suppose do you think that AI, maybe it was a little bit of hype that we're not far enough along into the AI era for that actually to be realized? Is it too soon, or what are your thoughts maybe on why AI has pulled back?
I think right. You make a good point here, and I think it's a lot like RCA was back in the 1920s. Television was just coming into its realm, and it was a transformative technology. But the problem is people had priced in 40 years of earnings into 1 year, and the RCA stock topped with the market in 29, and it took years and years and years before the stock was able to get to a new all-time high. I think AI is the future. I think the technology is transformative. It's going to change everything we do in life and how we approach business and a lot of other things. But we've priced in already years and years of future growth. And I think what's happening here is much what happened with RCA back in the 20s. your stocks are going to get hit just because you've gotten a little bit too ahead, too out in front of your skis here. And as the bear market comes, that we think is going to come broadly in stocks, I think AI stocks will get hit, but the technology itself will remain and will be something that we'll be contending with for the rest of our lives.
Okay, I want to talk about two areas of economy just real quick, and then we can move on. I wanted to first talk about tech, and then I wanted to talk about consumer retail, like the dollar stores and what's going on with them. About tech, there was a big pullback in tech. I've always thought that the tech price to earnings valuations were much too high. The counter argument to that was, but yes, it's transforming society. So they may carry a higher P/E, for a length of time because we are in the technology era. What's your feeling on why tech pulled back there? Was it just overall performance, or do you think people are looking at tech saying, hey, it's overvalued, maybe we need to rebalance into something else?
Yeah, I mean, it's a mania, just like there was a mania back in 2000 when we shot up again, getting way ahead of where that technology was going to lead us. And it has been a technology decade or two, but that doesn't preclude stocks from still being in a bear market. So yeah, technology got way ahead of itself. I think it turned into a mania. And one thing we look at is like the NASDAQ Dow Jones utility ratio, just looking at speculative, intensity versus conservative intensity. And it got way out of whack. And so I think this is just a natural progression as we move forward. Bear markets are as natural as bull markets. And they're there to, wipe out the excesses and then lay the foundation for the next rise in the market for you to get in. And the important thing is to recognize when the risks are high for a bear market. And I think the risks are exceptionally high right now.
Moving on to the consumer retail, I think it started with like Home Depots and Lowe's this quarter. People weren't rehabbing as much, a lot of, things like that. And then it moved to the dollar stores, Dollar General. And now I think it's what the other dollar stores, I forget the name. They're both reporting that they think going forward to the end of the year, the trends are that the consumers not be spending as much. And we're hearing that from a lot of retailers. And at the same time, we're seeing higher balances and defaults on like the credit side and on the auto side. It seems like the consumer could potentially be tapped out. Do you think that's part of the story here?
Yeah, the consumer is definitely pulling back. Credit card delinquencies are up, auto delinquencies are up, bankruptcies are up. All these telltale signs of the consumer pulling back from his spending days. Now, how far will that pullback be? We'll see. I think a lot of it has to do with the market. A lot of the wealth that consumers feel right now is because their 401ks have gone through the roof over the last X number of years. So if a bear market does start, and we think one is impending, then I think consumers are going to pull back even more than they have right now. But right now, seeing them do that, I think is kind of like an early warning sign. If you're looking around the corner now, you're seeing a little bit of trouble in terms of what's happening economically. We've got an inverted yield curve that just re-inverted, or uninverted rather, for the first time in 792 days, I believe. Longest inversion of the 210 yield curve in our history. And that has a great track record of, I think it's called every single recession over the last 50 years. So the fact that it's uninverted is almost like the clock is now ticking. And it's a countdown to economic contraction and recession.
Yeah, we talk about, every time I do a market report, I do one a week, I talk about that 2 and 10 year. And like you said, it's been going for about 2 years strong. And that has been a big indicator. Before we get into talking about what your outlook may be for the rest of the year, are any other areas of the economy that we haven't talked about, that what happened over the summer, and areas of concern that you may have that may be looking a little bit bearish for us?
Yeah, I think to us, the way we look at in our model is that stocks lead the economy. And so you're going to get your first hints of what's going to happen in economic numbers by looking at some of the sectors that are doing well or aren't doing well in the market. One of the most fascinating things to me is that people don't realize it, but the Dow Jones Utility Index is so far this year is up almost 20%. It's outperformed the Dow Industrials. It's outperformed the S&P 500. It's outperformed the NASDAQ. So you've got this highly defensive sector leading the market. And again, this is telling us, this is a clue that we see that impending trouble is coming down the road when you see these defensive sectors start to move to the forefront of what's happening in the market.
Yeah, that's a good point. And I want to take a look at banking for just a moment. I know Buffett is selling a bunch of his Bank of America shares. That made the news. Looks like the banking sector may be in a little bit of trouble. I think JP Morgan had a big loss in their commercial real estate division. One project, I think, was 292 million loss or something along those lines. How will this affect the banking sector if the consumer's not spending as much and maybe potentially defaulting on loans? And the economy's not doing as well? Are we going to be looking at trouble in banking again like we did early last year?
Oh yeah, definitely. I definitely believe so. I read an article just the other day that there was a CMBS, a bond put together backed by the debt from a major bank on Broadway in New York. It's the old Money Bank, M-O-N-Y Bank. Yeah. And the AAA rated tranche, the highest rated of that commercial mortgage-backed security, when they sold the debt, it only got 74 cents on the dollar. And everything below the AAA rated was wiped out totally. So you can see the problems in commercial real estate. We've been talking about it for months and months in our newsletter, and it's starting to really filter through to the economy. I don't think it's really going to take hold until the market starts down in a meaningful way. I think the market is the leading indicator. Once the stocks start turning down, then I think everything else falls into place. But we're seeing leading edges of it right now, like you say, in the commercial real estate sector of it. Even in housing retail sector, they're having some sales declines, and usually prices follow sales. So this is another area that we're looking at very closely.
Okay. I want to ask you one more question before we go on to what's going to happen the rest of the year. I lied. I had one more. The Fed looks like they're going to cut. It basically looks like they promised a cut before the presidential election. What's your view on the Fed's position? I've always thought they're between a rock and a hard place a little bit, but do you have any idea or have any thoughts about what they may do, for the rest of the year? Do you think that we're going to go back to heavy easing, or do you have general thoughts on the Fed's position in all of this?
I do. And our view is the Fed follows the market. Our models that we use to predict what the Fed's going to do in terms of the Fed funds rate incorporates what the 3-month T-bill is doing and what the 6-month T-bill is doing. And if you simply follow those two yields, you get a really good clue on where the Fed is going to go next, because it's just simply following along. Now, the Fed's been holding Fed's fund rate at 5.5%. Well, the 6-month T-bill yield is now, I think, just under 5%. And the 3-month is at 5.0 something. So if they cut just 0.25%, they're still going to be above the rates on 3 and 6-month T-bills. It will be the market will be telling them that's not enough. So the market is sending a signal to the Fed, hey, we see economic weakness out ahead of us. That's why rates are coming down. We're trying to entice more people to use money, and the Fed, if they continue to lollygag here, I think it's going to make it worse as the market turns over when we go down. So what the market is saying is that the Fed is definitely going to cut. It should cut by 50 basis points. If it doesn't, no matter what happens, 25, 50, I think investors are primed to be disappointed with whatever the Fed's decision is. So usually what happens in terms of market activity is the Fed cuts, you get a 1 to 3 day blast up. People are happy, and then it just fades away. I'm not even sure you're going to get the blast up this time. You might get a rally into the Fed cut on the 18th, and then the market just turns over and falls after that.
Yeah. What are your models telling you about the rest of the year? I know it's hard to predict things even with, technical models, but what's your sense for where we're going the rest of the year, given all the data we've gotten so far? I think all year, I would argue that earnings reports have been okay for like maybe the top percentage of the market, but the bottom, the part that sits below the surface of the water, if you think about the iceberg analogy, maybe hasn't done quite as well. Now we're starting to see the layoffs. Now we're starting to see the defaults and things like that. Is this presaging maybe a decline the rest of the year in the market, or what are your views on the rest of 2024?
Yeah, so there's three things that have come together for us. In fact, we just issued a joint report. Bob Prechter and myself and my partner Pete Kendall put together a joint report that just came out yesterday, 2 days ago, and everything was coming together. We said we have to make a statement here. Number one, the Elliott wave pattern shows a completion or very near completion of the rally from October 2022. That's the key to us. That's the model we use. Number two, sentiment is off the charts bullish, and we use that to either confirm or refute what we're seeing in terms of our Elliott wave models. And I think a report was just issued the other day that the U.S. household percentages that they hold in stocks versus other assets went to an all-time record of 42%. It was just under that in December of 2021, and that actually was the month after the top in the NASDAQ and a month before the top in the Dow and the S&P in January 2022. And before that, you have to go all the way back to 2000 at the end of the dot-com mania, when the percentage in stocks was like 38%. So we're at all-time records. So people own stocks; they're loaded in their household portfolios, super bullish equities, and that to us, combined with a pattern, is important. And the third thing is we're coming in, like I said earlier, into a seasonal period that historically has been very, very challenging for the market. And I think it's going to be really interesting this year. One of the things that we wrote about is the calendar, the Gregorian calendar, the dates and whatever for September of this year and October match exactly the calendar in 1929.
Oh, no, don't tell me that. I don't want to hear that.
It was really interesting to us when the Dow, back in September 1929, Dow made a high on September 3rd. Well, the Dow this year, September 3rd was a Monday, it was Labor Day, the market was closed, so the Dow made its high on Friday the 30th. The S&P futures actually made an all-time high, or not an all-time, but a new high on the 3rd when they were trading in overnight. But back in 29, the S&P held up until mid-September, and then by mid-October, everything started falling apart, as we all know from our history. So, nothing is exact. Nothing is exactly the way it's going to be then. But when you have a complete Elliott wave pattern, you have sentiment off the charts, you've got a calendar analogy going on. I think the next 2 to 3 months are going to be probably the most exciting time in the market that we've seen in years. So buckle up, get ready, and let's enjoy it. And let's not get caught up in whatever's happening.
Yeah, I see that. So if someone, in order to prepare for that, wanted to maybe rebalance their portfolio and look at potential alternative investments, I'm a big gold, silver guy. Obviously, I always advocate for having some gold in your portfolio. It's a portfolio stabilizer typically over time. But what are ways in which people can kind of deal with, a pending downturn that we're seeing in the day that we think is going to manifest in the markets? What would be some areas that you would look at to say, hey, maybe it's time to kind of look at some of these other, investment classes?
Yeah, well, the main concept that we've been talking to our subscribers about is safety. You really want to be safe over the next coming months. And the great thing right now is that there's ways to be safe and still get a good return on your money. For example, 3-month Treasury bills are yielding over 5%. So, and that's compounding. And they've been doing that ever since April of last year. So you're compounding at 5% with zero risk. The other thing is 2-year floating rate Treasury notes, which is kind of a corollary to 3-month T-bills that you can lock in a rate a little bit longer than, say, a 3-month T-bill, but they're over 5% too. So you're compounding at 5%. Another thing we've been advocating now for a while is gold. Gold, and many people don't understand or realize this because they're all tied up in the stock market. But so far this year, the Dow is up 10%, and the S&P is up about 17%. The NASDAQ 100 is up about 15%. You know what spot gold has done this year? It's up 21%. It's double the performance of the Dow. And this is a safe asset that's had a really nice run this year that we still think is in a bull market. Now, September tends to be a tough month for gold seasonally. and we could have a pullback here, but we don't think the bull market in gold is over based on the Elliott wave patterns that we see. And the fact that gold has outperformed all of those major stock indexes in 2024 to us is a sign that it's still leading and it's out front. And that's another area that we would look at to maybe to allocate some assets.
Okay. I know you mentioned commercial real estate earlier in our conversation coming under a lot of pressure. Are there any other areas of real estate, maybe residential, farmland, that type of thing, that you think could do well? Or is real estate basically just flashing a warning signal in which you stay away from it?
Well, yeah, and a lot of it has to do with real estate for investment, real estate for utility. I mean, if you're going to live in your house, you're going to live in your house, whether it goes up or down. Real estate for investment, we would definitely stay away from. Farmland is interesting because I think commodities in general are very underowned relative to equities. And I think we're seeing a C wave, a tidal shift, a tidal wave move that's going to reallocate into commodities and out of equities. And it's going to take years and years to happen, I think. But farmland might be very interesting. And I can't get into any specific farmland investments at this point because I haven't looked specifically to see if there's any sort of vehicle or retail investor could maybe get into. But that might be an interesting area. And we're probably going to take a deeper dive into that in the future. But I would stay away from retail housing and commercial real estate. They're way overdone and they're due for a decline. And usually they decline with the market when things get really rough.
It's funny you mentioned commodities, and I didn't even think of it. I should have. Talk to us about commodities. What sectors do you think could outperform? Do you think we're in for like a copper, uranium, or do you think it's going to be more the traditional metals, or do you think the whole commodity complex potentially could do very well over the next
year? I think that generally the whole commodity complex, I'm specifically maybe looking at grains right now. They've been beaten down a lot. I think they have the potential to rally. If you look at some of the positioning through the Commitment of Traders report, and you look at managed money accounts, they're record bearish commodities right now. And usually this cohort is a trend following group. They get more bullish on the way up and more bearish on the way down. And at turning points, they're usually caught in major wrong way bets. And so the fact that they're historically bearish commodities right now, to me, paradoxically, is a time that you should be looking at commodities for a rebound and a turnaround.
Okay, sounds good. I think we've covered most of the market. Any other thoughts that you had before we get on to talking about your company, Elliott Wave International? Anything that we haven't covered overall in the economy?
No, I think things are going really interesting. And I would just say to everyone watching this, think safety for the next 3 to 6 months. Just think safety. How can I be safe? How can I have cash so that I'm able to redeploy maybe at lower levels? And if you can do that, I think you're going to be in a really good position.
All right. Tell us a little bit about Elliott Wave International and how people can get your latest research reports and other information.
Yeah, it's very simple. We come to our website. It's elliottwave.com. That's one word, Elliott Wave. And there's 2 L's and 2 T's in Elliott. So it's elliottwave.com. And we've got a ton of material on our website. You can click and sign up for various products just to check them out. We always have informational and educational videos going on. It's a great website just to kind of click around and see if there's something that might interest you. So www.elliottwave.com.
Fantastic. Stephen, thank you so much for coming on. I appreciate you. And I appreciate all of your reports that you had. You really set us up for the summer and probably did the most accurate prediction of what was going to happen. So really respect your work, and thanks for coming on with us again.
Thank you. I really appreciate you having me on.
All right. We'll have Stephen on again, perhaps as we get to the end of the year, to kind of review some of what we talked about here and maybe get a forecast for 2025. This is Rob with the Freedom Report. Stay tuned for other content throughout the week as we get more into the social and political content we'll be putting on the channel. Until next time.